So we're going to spend the next few minutes talking about really a topic that we here at Treasury Strategies, and I think all of our panelists and probably most of you listening have been thinking about and talking about fairly consistently, and that's Brexit as well as what comes next. So we're going to start by talking about the British referendum, what we're calling Brexit, to leave the EU. Like I said, it's pretty much all anyone's been talking about, at least here in the United States, and I'm sure in Europe as well. The vote and then the coming Article 50 declaration, it's going to have both short and long-term consequences for Great Britain, for the EU, for European leadership in general, potentially other trade blocs, and the macroeconomic economy in general. Brett Friedman, as a director with Novantas, and I consider you to be a risk expert here, what are your initial thoughts about this?
Well, I can say, unfortunately, I was thinking about it this morning. Over the course of my career, I've lived through about 10 of these, possibly more, of these extreme shocks to the market, Brexit being just the last one. They all kind of follow the same pattern, which is very akin to the 10 stages of grief that markets go through: the shock, the emotional thing, the anger, the panic, the guilt, and then finally some sort of hope and accepting the reality of it. And Brexit, we're sort of in the last stage of here where they're accepting the reality, the market is at least, that something is going to, that it's actually going to happen in one way or the other. Unfortunately, what I think is that although that's true and the markets are calming down considerably, especially with what's been going on in the UK in the last couple of days with the election of Theresa May, et cetera, or the coronation of Theresa May, whatever you want to call it, there's still long-term issues with the EU, and Brexit was a symptom of problems within the EU. It wasn't a cause of these problems. It was a symptom of these problems that aren't going to be going away anytime soon. And there's things that are happening within the EU that can cause a reentry into the EU to be particularly problematic. The assumption that everybody seems to be making is that the EU is a stable entity that will be around in a couple of years, that Brexit, when they re-enter, that there will be something to re-enter to. And I think that's an assumption that's going to be tested over the next couple months to couple years. And so I don't think that although the market is calm now, I don't think that this is going to last. I think there will be extreme spikes in volatility as the probability of the reentry comes and goes and new problems emerge with the EU that questions its long-term viability.
Right. Thanks. Thanks a lot, Brett. We were talking here internally that Brexit isn't a binary thing. It isn't clear whether this is going to be a divorce or just a different defined relationship, right? So Steve Baseby, as the Associate Policy and Technical Director with the Association of Corporate Treasurers, you saw those stages of grief, right? You're in London. You saw everything go down. So let me ask you, what was the initial reaction there, and what do you think, generally speaking, comes next?
Well, the initial reaction for corporates was surprisingly muted, and that's because many of them are, in fact, multinational in their nature, even if not in their structure. And their reaction had been to, say, to pre-borrow where they were concerned there might be some liquidity issues, and to cover themselves with foreign exchange hedging for their movement of goods and services in and out of the country. And so we're in a stage which we call a phony war at the moment. Nothing much is happening, and everybody's sitting around just getting on with life. The issue might emerge more as we go forward, as foreign exchange hedges start running off, and can costs be raised in the market? We just have to see where that goes. But from the capital markets concern, which is where we get the money from, it is more of a concern as to whether we preserve some kind of passporting or whether we have to rely on a purely domestic economy. But it's had some strange side effects which don't strictly affect cash management, but do tend to affect the markets overall. We've seen a surprising rise in equity markets and bond prices as people are chasing yield. We know that some of that is because particularly the top end of our stock market is dominated by dollar-based multinationals. So in fact, their value has gone up in real terms. But we also see a quiet period where there's not much need for anybody to borrow, including government. And we are waiting to see what happens when the government does start to borrow in any meaningful way again.
Sure.
The phrase I use, challenging the market on those very low yields that are there.
Right.
And just is the risk that that's the moment of truth where everybody says that, yes, you have got a problem if you're going to detach yourself from this much bigger economy. The other point that I think is made there is very valid, that that much bigger economy in the Eurozone, we're not too sure where that's going either. We have French elections next year, where the idea of a Frexit is already being floated. We have a movement in Italy to exit the euro, but not the EU, which is quite strong. We have still no firm government in Spain, where there are similar debates over whether you're really getting anything out of being in the EU, albeit Spain has been one of the countries which has received much of the EU largesse, as visitors will notice from his fabulous facilities. But there is this concern that the Euro bloc and the broader EU itself is not something that's going to remain stable. What this means for corporate treasurers is you could be getting into a period of extreme volatility, which you have to manage on a day-by-day basis, and the difficulty of pricing your imports and your exports.
Thanks, Steve. Thanks. Let's talk about beyond Brexit, just in the interest of time here. I mean, we all have a strong desire as humans for pattern recognition, and I think that bleeds a little bit into maybe crystal ball forecasting, but there's similarities, as you mentioned, Steve, in Brexit to other things that are going on globally, driven by populism, macroeconomics, any other influences that you can point to. You know, you mentioned issues throughout the rest of the EU. We have our elections here in the United States. There's challenges in the Bentic countries, and obviously we've discussed in previous quarterly discussions around Greece and Spain being on the radar. Brett Friedman, what are some other areas where our audience, and specifically corporate treasurers, should maybe direct their attention?
I think the most obvious one, which has come to the fore lately, but post-Brexit, but has been brewing since 2008 to anyone who's been noticing or reading any of the popular or any of the sort of specialty press, is what's been going on in Italy with their ongoing bank crisis, which has been intensifying over the last couple years to months. The basic situation being basically that Italy has about $400 billion US of sour loans on the banks have on their books, and that's roughly about 20% of their GDP is non-performing assets. Just to put that in context, that's equivalent in the U.S. to about $3.4 trillion of bad loans, which we do not have. One bank, interestingly enough, Monte dei Paschi de Siena, which is the oldest bank in the world, which was founded in 1472, believe it or not, has about 47 billion euro in bad loans. So what the Italian government, and this whole situation is a little microcosm of what's going on in the EU and the problems that it's facing. The Italian government wants to inject 40 billion to shore up their banking center. The EU has some, what they call, they have some rules that basically bondholders in these banks have to take the hit before any money can be injected into the banks. The problem being that in Italy, due to some tax laws, all of those bondholders are retail investors, small mom and pop, your grandmother, et cetera. And so failing some sort of compromise, you know, there's going to be a real problem. Of course, the EU has been saying that there is going to be no compromise, and everybody knows there is going to be a compromise. But this is a classic situation that the EU seems to get itself into on a regular basis. It highlights the north-south problem, creditors versus debtors, Brussels rules versus national politics, et cetera. And eventually, and they're going to paper this one over just like they papered Greece over, but eventually one of these things is going to come home to roost. And one of the biggest problems that we're facing with the EU is that the last couple of stress tests for the international economy had seen incredibly high correlation between markets.
Absolutely.
So when something happens in Italy, it can affect U.S. markets very strongly and for a period of time.
Yeah.
And that's what I would worry about. So,
thanks, Brett. Thanks.
Sure.
Yeah. Hey, Roger Merritt, Managing Director at Fitch Ratings. Do you have more to add or a different view? I think we had talked about some follow-on effects here. I mean, what do you think? What's your point of view? What's going to happen next year?
Well, I think it is a bit of a crystal ball exercise. But I take the earlier comments that the EU has some real structural challenges ahead of itself. The point about the Italian banks, I think, is exactly right. We've recently seen that Spain and Portugal being singled out for sanctions for not adhering to EU fiscal policy constraints. Scotland has said that they will have a referendum to re-enter the EU, which I guess would be a reversal of the last referendum where they agreed to stay as part of the United Kingdom. So, what we see here is just an environment of extreme uncertainty, and we all know that uncertainty is not a recipe or a key ingredient for robust economic activity, which you certainly see. You talk about one of the great challenges out there right now is just the great unknown with respect to low and even negative interest rates. We have $13 trillion of debt globally that is yielding a negative interest rate. So we're in uncharted, untested waters, and so I think that just means that everybody has to manage this very carefully, and as it was said, really on a day-to-day basis.
Thank you, Roger. Debbie Cunningham, Chief Investment Officer for Federated Investors. I'm going to let you close out our panel discussion. What do you think? What comes next? What does that mean for short-term rates? What does that mean for our Fed watchers in the audience?
Sure. I see everybody likes to focus on their own market, and for money funds in particular, I think there's a couple things. Number one, what the Brexit impact will be on Yellen and the FOMC. Obviously, we were in line for what we thought were 2 rate rises in 2016, and I'd say for the most part, we're down to 0 or 1 now from a forecast perspective, and it's all entirely based on Brexit because our own U.S. economy has been picking up speed at this point, and inflation has been actually improving. So that's a question. I do believe from our perspective that we're still on a single rate rise probably in September as a U.S. outlook. We also are concerned about what it does from a bank health perspective. Money market funds generally invest in a lot of banks, offshore as well as domestic, and what this does to the ongoing health of the British banks as well as some of the large global banks is a question we have. And then lastly would be offshore regulation. So we've been going through in the U.S. a lot of change from a money market fund regulation. We're all kind of waiting with bated breath what happens in October. The offshore side of the equation was actually sort of just coming to a head, and in fact, as I understand it, the first trilogue debating the offshore money fund regulations is still in fact happening today in Brussels and will continue next week. So I'm not sure what this does to derail those, prolong them, but in any case, that's a question for our industry also.
Thank you, Debbie. Thank you so much. And thank you so much to everyone who participated in today's panel. Steve Baseby, the Associate Policy and Technical Director with the Association of Corporate Treasurers, Debbie Cunningham, Chief Investment Officer for Federated Investors, Roger Merritt, Managing Director of Fitch Ratings, and Brett Friedman, a Director with Novantas.